Hey everybody, welcome to this free edition of our Trader User Group, a weekly roundup for the trading week ending June 25, 2021. I'm Preston Brent. Thanks for tuning in. This week's theme is the Icarus Conundrum. For those you don't know who Icarus was in Greek mythology, he was the little boy that had wings made of wax and he flew too close to the sun. They melted and like all Greek mythology, ends tragically in crashing back and drowning in the ocean. Anyway, I call it the Icarus conundrum because it's probably more the Fed conundrum, but we'll get into that in just 1 minute. Let's take a look at how we've done this past week, which is a fairly strong week. Take a look at kind of where we're going and, just a little bit about insight into what I'm thinking right now. So let's look at the index performance. As you can see, a lot of green on the screen right here. The Dow, S&P, NASDAQ, Russell all had a very strong week, especially the Russell up 4.6%. Year to date, everybody's very strong. I mean, we had the prior week, if you guys don't remember, stocks rebounded from the previous week's declines. S&P and NASDAQ all new all-time highs, not with the Dow and the Russell, but S&P, NASDAQ clearly boosting their gains. We're seeing some moderating of inflation fears, although that's still going to weigh on investor sentiment, I think. But we're seeing some commodity prices from the spike earlier, about a month or so ago, coming down, like lumber and some of the others. Some of it is just some of the unwinding of the supply chain issues in commodities. Others came under pressure when China released some of their stockpiles, like iron ore, copper, things like that. We also had this past week Fed Chair Powell. He kind of is trying to soothe the markets and Congress when he talked about this recent spike in inflation is going to be transitory. And the markets seem to be buying off on it right now, as you can see on the screen. Everything is in the green. PE ratio, I mean, very strong. PE ratio, forward PE at 22.52. And you can see the dividend yield for the S&P came in at 1.35%. 10-year Treasury at 1.54. So there's still about a 19 basis point spread between the 10-year Treasury S&P dividend yield. The Treasury moved up 10 basis points for the week, but we got a 19 bip spread between the two. So that's still a lot to encourage money still into the equity markets. The VIX, as you can see, came down 32.52% for the week to close out the week at 1562. A very good week volatility wise. We're coming back down to these lower levels. Every time we get into the 15s, we always see a spike and fall. Right? Sector performance wise, energy is still not only leading for this week, but leading for the year too. And as you can see, the worst performing sector was also in the green. So we had green all around for the week. And it's just a very strong week, right? Just a little bit opposite of what people were expecting. And if we look at the basic information around this, if we look at the economic data, right, surrounding the week, we saw durable goods kind of came in a little bit less than expected in May. Weekly jobless claims came in a little bit higher. There is a big supply versus demand issue in the jobs market. Job openings versus candidates to fill those openings. So it's more of a supply issue, not a demand issue. There's a ton of jobs open right now. Problem is, a lot of the job candidates are asking for more money. And once companies pay them more money, that tends to be a sticky inflation issue. So all of this is going to be worked out over the next 3 to 6 months as we round out the second half of 2021. Okay. And if we look at U.S. Treasuries for the week, right? I mean, inflation fears were kind of on and off for the week with Powell continually saying inflation is transitory. Although there are 7 of the 12 voting members of the Fed, the U.S. Fed, talking about possibly hiking rates in 2022. Although Powell is not saying that, he's saying 2023. So if inflation continues to come in hot, I think the market's going to have to recalibrate to a 2022 rate hike. We do have the Fed meeting in July. But the big meeting I think all the markets are going to be following is the meeting out in Jackson Hole, Wyoming in August. That's typically when the Feds talk to where their strategy is for the next 12 months. And it's a meeting of all the muckety mucks, all the central banks from Bank of Japan, the US, of course, Canada, the ECB, Great Britain. They're all going to be meeting and they're all going to be talking out of the same hymn book. Okay. Remember, they're already talking about cutting stimulus in Japan, or I'm sorry, in the ECB and in Europe. So they're already talking about it. But we're seeing some of these inflation fears in here. The core personal consumption expenditure index, the PCE, which is what the Feds follow, had risen 50 basis points in May, bringing the year-over-year increase to its fastest pace since 2008, 3.4%. And that's what the Feds are looking at. But really what they're looking at is the job rate, employment rate. They've kind of shifted their stance to following jobs rather than inflation data. And they want to be more outcome based rather than just what they expect to happen with inflation. So this is going to be a real interesting thing coming up here. Okay. The other thing that happened this past week, and I told all our members, just go long bank stocks because Thursday after market close, we're going to get the Feds announcing their stress test for all big money center banks. And of course, it all came in strong. So financials had a very good week. Okay. I mean, the Feds probably on Monday are going to announce, or they gave a green light to the big banks to do more dividends and share buybacks. So we're going to see that probably being announced early next week by banks. Wells has probably the most money saved up to do share buyback and dividends. So we're going to see all of the big banks probably start off the week. They should start off the week fairly strong, right? As I was telling our members. And of course, if we look across Europe, same thing in Europe. Everything was in the green, everything, including China they were 3 weeks in a row in the red, but they finally had a very strong week. Everybody is year to date in the green. So far, mid-year, everybody's looking good. In fact, we're seeing analysts increase their earnings per share growth for the S&P. Earnings estimates, had started off the year of 2021 around 160 to 165, and now they're at 185 to 200. I mean, they're just growing, and we got Q2 earnings kicking off in another few weeks. Those are expected to knock the ball out of the park. But as always, as I tell our members, don't focus on where earnings are now. Focus on what their go-forward guidance is going to be. I'm seeing earnings per share estimates for the S&P continually going higher. And at the end of the day, even with inflation coming in and interest rates gradually grinding, they may grind higher through this year. If earnings per share are growing at a very strong rate, that's going to overcome smaller gains in interest rates. Okay. And keep in mind the Fed balance sheet is still sitting around 8 trillion, right? Just a shade under 7.9, which is due to expand again if they get these infrastructure bills out of the way. So there's just a lot of things going on in the markets that could upset this thing. And of course, if we look at China, right, both the European markets, we did see in Europe, Queen Bee Lagarde, he told the ECB and the European Parliament, or she told the European Parliament that they don't want to withdraw support too early. So they're still very dovish, as is just about all central banks with the exception of China. Although China did surprise people. Notice they had a very strong week. And one of the reasons why was that they injected some liquidity in their financial systems. And that was the first time they did it since February. So that probably helped China for the week. Just understand when the Fed, the central banks, whether it's the ECB, the Bank of England, Bank of Japan, or the PBOC, People's Bank of China. And the people have nothing to do it, by the way, in China, but they call it the People's Bank just because it sounds good. When they're all injecting money into the economy has really one way to go. It's typically up. That's why the saying, don't fight the Feds or don't fight the central banks. When money gets injected into the economy, really is hard to fight it. Now, eventually, it's going to cause more damage on the backside of the mountain, but right now, we're still climbing the mountain. Okay. So that's a little bit about what I'm looking at. Let's go take a look at the charts here real quick and just kind of scan through. and just kind of see where we're sitting right now. And as a reminder, we're coming up to a big holiday weekend here in the United States, 4th of July, our Independence Day. So that's going to be coming up in 2 weeks. So the U.S. has a long holiday weekend. I think the 4th falls on Sunday, so Monday will be a national holiday. All markets will be closed. People will be leaving early Friday to take a long holiday weekend. But that's not next weekend, that's the weekend after. What you're seeing on the screen here is you're seeing the E-mini S&P 500 futures. And you can see we hit all-time highs on Friday. We had a high point of 42.76.75. Now, my high for the year, if you guys remember, I had a forecast of 41 to 4,300. All right, and I called it out when we were in the 3,800 range. And I know some people said that was a little bit much, but that was what I looked at, looking at all where earnings were going. And sure enough, we're almost at the high end of my range, 4,300. Now, we may even get up to 4,300 over the next few weeks, but I do see some downside coming this summer. I've been telling you guys here on our weekly roundup every weekend that I see anywhere from a 7 to a 12% pullback sometime in the summer months leading up to the September holidays, marking the end of the summer here in the United States. Okay. But right now, it's still everything is in the green. And as I showcased our members, you can see these candlesticks around the 50 EMA were very similar. Right? They come below the 50 EMA and then they bounce back up. And that was kind of what I spent a lot of time with our members on, just to look to see this downdraft that we had the prior week. Is it going to continue, or is it going to rebound and go back higher? And of course, you never know, but you want price action to help you out. And it told us that this is where we're going. We're going back to the upside. And that's kind of where we leveraged ourselves, right? Now, if we look at the, if we look at NASDAQ also, because interest rates have come down a little bit, NASDAQ also made an all-time high on Thursday, right? So we're getting tech stocks also participating. And the reason why is we've seen interest rates come down. If I come down and just show you the 10-year interest rate, I mean, it moved up a little bit towards midweek. You can see it. It actually, though, has been coming down. And in fact, interest rates have been coming down since the end of March. So April, May, and June, all of the second quarter, interest rates have been making lower highs and lower lows, finding a bottom here near term on the 18th of June. Okay, just a week or so ago. And now we've been edging up. I still believe that my near term, my target for interest rates before the end of the year is going to be around 195. So I think because we've had this big move in technology, keep in mind as interest rates go higher, technology stocks, high growth stocks do not perform as well. And I see this 3, 4, 5 Elliott wave pattern setting up here on a daily chart in the 10-year interest rate. Taking us up just under, a shade under 2%. Now, depending on how we get here is how it's going to drive tech and a few other key stocks that are, highly correlated to increasing interest rates. If we get there very quickly, like if you look at the left-hand side of the screen, you can see how fast interest rates were moving higher. That was a killer for technology. But if we just grind up over a period of time, let's say over the next 120 days to 180 days over the next 6 months, then technology can handle that as long as their earnings come in strong. Remember, they got high PE ratios. Their earnings per share and their forward guidance slips, then they're going to be punished in the earnings confessional that's coming up in the next 2 to 3 weeks. Right? So we got to watch that very closely. Now, if we come back over here and we look at the Dow was punished over the past few weeks. In fact, it was trailing everybody else. If we look at the Dow, you can see how low it went below the 50 EMA, and then it just regained over this past week. This past week was very strong for the Dow. And if we look at the transports actually are a lot worse. Now, remember, the transports tend to lead the Dow in the market. So this could be signaling that we do and we can expect some downside action here over the next 4 weeks. So as we round out July, again, I would not be surprised to see the markets run up and kiss 4,300 just because they can. And then as we get into earnings, it could be a sell on news. We get very strong earnings for Q2, but the forward guidance isn't strong enough to keep the stocks at the high PE multiples, given the fact that we're going to be raising rates. And you're going to see a revaluation in the markets, which would cause the markets to fall 7 to 12%. Keep in mind, since the COVID bottom in March 23rd, we've had about 6 or 7, depending on how you count them, pullbacks in the market that were greater than 5%. The average pullback has been about 7.5%. We had one a little over 10%. And the NASDAQ, every time we pull back, pulls back the most. Okay. So clearly a pullback is going to be in order. I do see it. Now, I think the odds favor it more than a 60-40 chance that we're going to get a pullback. What's going to set it off? I don't know. Pick something. It could be the earnings. It could be inflation data comes in higher than people expect. We got a major deal coming up here for all of you non-U.S. folks. We got a major budget due to hit the U.S. Congress in extending money in August. We may not, it's got to be voted on to increase the budget size. That could be a big battle. We've had those before where the markets fall 10% because the Democrats and Republicans can't come to an agreement. Then they finally come to an agreement at the 12th hour at midnight, but not enough to inject or not enough to stop injecting a lot of volatility in the market. So there's a lot of reasons that can move the market lower, even with earnings per share coming in like gangbusters. So we're just going to have to pay attention to it and watch. Okay. As always, we follow price action, and that's going to help us out. So this is a little bit about what we're seeing right now in the markets. You can see the transport's just a little bit weaker than normal. You can see the Russell futures, the last all-time high it made was way back over here in March. And then we've just been running sideways doing this porpoise action, all right? Have not been able to get escape velocity and clear this 2366 area. So we're going to see how the markets shape up and how it handles all that. And of course, if we look at the VIX and volatility, you can see here we're back down near these areas where VIX tends to want to have these spikes to the upside. Okay, this was the spike where we got about a 5% pullback back in early May on the S&P. But I'm looking to see something that'll get us spiked over 30. Coming up sometime this summer months. We'll see something, I suspect. If we look at the front month skew, we're not in backwardation. If you look at this, you'll see the markets are all in the green, barely, but this just means that there is no backwardation in the term structure of volatility. So that says the markets are fine right now. And if we look at the back month skew comparing July and August futures, we're solid in the green. There is no worry. There's been a lot of volatility that has come out of the VIX futures going out in time, as evidenced by this chart. I mean, it's just fallen off the table. So the deeper in the green we go, the more contango the market, which is a normal term structure in volatility, which means the markets are not concerned at all right now. And of course, if we look at the 30-year bond market, it's starting to roll back over. Right? I want to see if it breaks the 50 EMA, then selling bonds. I think bonds are going to close out the year at 150, which is about an 8-point move in the bond market. Remember, it's $1,000 a point for every full solid handle in the bond market. Right now, it's at about one. It closed the week at roughly 159 and one tick. So if it goes down from 159 down to about 150, that's about 9 handles. That's $9,000 per contract. That's where I think we're going to end up sometime in Q4 as inflation and boom Powell realizes that inflation's a lot hotter than they thought. And I don't know how it couldn't be because they just got so much money in the economy. And that is going to pump interest rates a little bit higher. So that could be the crowbar that, opens the door for lower rates. We'll see. Okay. And then, of course, if we look at the US dollar, it has moved up a lot higher than people felt. But again, just like the bond market, I think the days of being at higher altitude is coming to an end. The bonds are going to come back down along with the US dollar. And then for longer term trades, I do like the euro. You can see here with the euro, I think we may get one more move lower in the euro, one more move higher in the dollar, and that'll sum it up for the year for these two. And then it'll be interesting to play through the end of the year, longer the euro, shorter the dollar. Okay. Now, if we come over and we look at gold, gold is a tricky one because it is in some respects manipulated by sovereign wealth funds in countries that buy and sell gold, you know, and I think that gold is going to go higher, um, and I do believe that it's going to be in a kind of a consolidation mode here for a bit, and then it's going to move up. Same thing with silver. I just think it's going to be moving up. Copper, one of our trades that we've been playing, you can see copper broke this trend line. I would expect a retest of the trend line and then maybe a move lower. Now, if we get a 10% pullback in the equity markets, copper is going to come back down and it's going to find support, first of all, in this shaded zone here, right around the 4 level. I think that'll break and it's going to come back down to around 3.5. So copper has, I think, outside of this short bounce is probably going to roll over a little bit more. All right, that's kind of what I'm seeing in copper. And then, of course, if we look at oil, we're seeing OPEC talking about increasing their production capacity by 500,000 barrels a day. That's going to have a tendency to put a cap on some of this upward movement in oil. Over here, I had our members fading this move to the downside, and it was a nice little trade where we were trading, condors with all calls skewed to the upside, of course. And now right here with this kind of trade, any kind of broken wing fly, I think makes sense to me, to our members, where we could take this thing and just play it. Okay. I don't see too much more upside near term. And yeah, I get that a lot of the commodity traders and others are saying that oil can move up to 100 a barrel, but I don't see it. If the economy goes hard down, I think it's going to pull down oil as well. So we'll see how this thing plays itself out. Nat gas is the one I'm watching more closely. Look at the chart here on nat gas. It's coming up to a key resistance level here with nat gas, and we did have a big breakout. Let me put it on a weekly chart and I'll show you what I mean. If we look at this weekly chart right here, we're breaking out and coming up to my resistance point around 3.6 to 4. If it gets up there, then I'd be interested in fading this move. I don't think it's going to get much up higher than this. And what's driving it up here is forecast of a very hot summer, right? You can see the last time we got short nat gas big time was over here. And you could see how fast it went up. And that was when I think a big commodity firm just went belly up, lost a lot of money. Haven't seen and heard from them again. And now it's, but you'd never want to go naked short in any commodity. It's just a very dangerous prescription. You want to do it as a spread, or you want to have it hedged where you may be short, but then you go long some of the option contracts to hedge that trade, right? Depending on whether you're long or short the futures contract or in the option market. Here with nat gas, we play the option market. So you've got a defined risk trade. And we've got this Elliott Wave 5 sitting up here that says it could extend up here. I don't see it getting up there, but I do see it still moving higher. So there's going to be some interesting plays in that one too. Members, I've got some really interesting stocks for us coming up that we'll review this weekend that'll play off on a couple of the dynamics going on in the market. Otherwise, everybody else have a great weekend. If you're not a part of our group, I highly encourage you to come in. We're doing real well with the trades we got. And I think the next 6 months is going to be a lot more tricky than people think. And the next year in 2022 and 2023, it's going to be even worse. So, but that means there's going to be great opportunities for us. All right, everybody, have a great weekend. Members, I'll see you tomorrow night for our weekly market watch. Take care, folks. Ciao now.